Ever feel like you're trying to piece together a puzzle with just stacks of dense reports?
Yeah, definitely. Information overload sometimes.
Well, today we're sort of snapping some of those pieces into place for you. We're doing a deep dive into a BY recommendation for a company called Garware Hi-Tech Films.
That's the one, GHFL. We've been digging through the analysis from Monarch Networth Capital.
Monarch Networth, okay.
And, it points to a potentially pretty significant opportunity here.
Okay, so for our listeners, the mission today is really understanding why this bullish outlook on Garware Hi-Tech Films, GHFL.
Uh-huh.
What does this company actually do in the world? And, what can their prospects tell us about the dynamics of the global specialty films market?
And maybe some investment avenues, too.
Exactly. Consider this your express route to being, in the know.
And we're not just, skimming the surface here.
No.
We'll be dissecting their business model, how they actually work.
Day-to-day stuff.
Yeah, their financial performance, the numbers, then their anticipated growth path, and even the potential headwinds they might face.
Okay.
All based on this analyst report.
So kicking off, Monarch Networth Capital has this BUI rating and a whopping 62% upside potential mentioned. That seems pretty bold.
It is a strong call, yeah.
What's the core story? What's driving that kind of projection?
Well, the central theme, it really revolves around an expected turnaround.
A turnaround in what exactly?
In some recent unfavorable tariff policies in India,
Ah, okay. Tariff.
Those have really been a drag on the company's performance, apparently. The feeling is these challenges might actually flip to become advantages.
So it's not just like general market optimism. It's a specific thing they see changing.
Precisely. And then layered on top of that, the analysts are forecasting pretty robust growth in their earnings and their cash flow over the next few years, specifically fiscal 24 through 26.
Okay. And what's powering that expected surge? Is it all just this tariff thing?
Not entirely, no. A major catalyst is GHFL's strategic focus on what they call value-added or specialty films.
Right. Not your standard plastic wrap, then.
Definitely not. Think maybe the advanced film on your phone screen that resists scratches.
Okay, yeah.
Or specialized packaging, maybe, for sensitive medicines to extend shelf life, that sort of thing. High-performance materials for specific jobs.
Which links into a much bigger picture, doesn't it? The report mentions a pretty substantial global market for these specialty films.
Absolutely. This isn't some tiny niche.
Yeah.
The worldwide demand for these advanced films is quite considerable, and it's growing.
So a big pond for them to fish in.
Exactly. A vast potential landscape for GHFL.
Okay, so they're in this high-tech film business. Let's get more concrete, though. What do they actually do? Let's unpack the business model a bit.
Okay. So, in essence, GHFL is a player in the specialty films industry. These are, like we said, engineered films.
Right.
Designed with specific properties, tailored for particular uses. Think maybe car wraps.
Oh, yeah. You see those everywhere now.
Right. Changes the color, protects the paint, or specialized films and solar panels, that kind of application.
Gotcha. And who's buying this stuff? What industries?
Well, they cater to a pretty wide array of sectors globally. Packaging is big. Think high-barrier films for food, pharmaceuticals.
Okay.
Then the automotive sector, window tinting, protective films, and even building infrastructure.
Really? How so?
Films used in, say, energy-efficient windows or other construction materials.
Huh. So a pretty diverse customer base. Now, the report mentioned a strategic shift towards these higher value products around FY17.
Yeah, that's right.
Why was that so important?
Well, that shift is critical because these value-added specialty products, they typically generate much, much higher profit margins.
Okay. Compared to the basic stuff.
Exactly. Compared to commodity-grade films. So that pivot was a deliberate move to boost their overall profitability, move up the value chain,
Makes perfect sense. Focus where the money is better. And operationally, are they mostly a manufacturing company?
Yes, fundamentally. Their main activity is manufacturing and then selling these high-tech films.
Right.
They've got production facilities, and then they handle the marketing, the distribution to their global customer base.
And where are these films mostly sold? Is it mainly in India's story?
Actually, no. Interestingly, the majority of their revenue comes from exports.
Oh, okay.
The Americas and Europe are specifically called out as key markets. So this is definitely a company with significant international reach.
That's a really key point. They're not just dependent on the Indian domestic market. What gives them an edge, then, in this global space? Any competitive advantages noted?
Yeah, the report points out a few strengths. First, they have an established significant presence. A strong global foothold is the phrase used.
Okay.
Building that kind of network takes time, right? Second, they offer differentiated high-performance products.
So, unique stuff.
Suggests they have real expertise developing films with unique properties for different clients. And finally, they're established distribution channels,
which are crucial for reaching those markets.
Exactly. Getting the product efficiently to customers in the Americas, Europe, those key areas.
Okay, so global player, specialized products, the logistics to deliver. Got it. Now let's dig into the financials. Show me money, as they say. What were the highlights that grabbed the analysts?
All right, financials. Looking at revenue trends, first off, we see a pretty consistent upward climb.
Okay.
Fiscal year 22, they reported $13,026 million. That grew to $14,380 million in FY23.
So decent growth there.
And the projections out to FY27 are quite ambitious. They're looking at $28,979 million.
Wow, that's basically doubling in a few years. The report also flagged a CAGR, right? Compound annual growth rate?
Yes, 9.8% CAGR over FY17 to FY24.
What does that tell us? Nearly 10% growth historically.
It tells us they've got a solid track record, even before these more optimistic future projections kick in.
Right.
For a company in this kind of sector, that consistency suggests a healthy, expanding business. They weren't starting from scratch. They've been growing steadily.
Okay, good context. What about profitability? EBITDA is usually the key one. Earnings before interest, taxes, depreciation, amortization. What's the trend?
Right, EBITDA, also showing an upward trend. It went from $2,177 million in FY22 up to $2,381 million in FY23.
Okay.
But the projected EBITDA for FY27 is pretty significant, $6,984 million.
Whoa, okay, that's a huge projected jump again. The report links this EBITDA improvement back to that focus on the value-added business, right? How does that work exactly?
It was pretty direct. Like we discussed, that strategic shift towards the specialty films, those carry higher profit margins.
Got it.
So that a bigger slice of their sales comes from those more profitable products.
Yeah.
Their overall earnings before all those deductions, the EBITDA, it just naturally goes up.
More high-margin stuff sold equals better overall earnings.
Exactly. It's a direct result.
And the bottom line, profit after tax, PDA.
Okay, there was a slight dip, actually, from $1,672 million in FY22 down to $1,661 million in FY23.
Oh, interesting. Why?
The report doesn't detail the specific reason in the excerpts we have, but perhaps related to those tariff headwinds or input costs. However, the projected increase by FY27 is dramatic.
Okay.
They're projecting $5,217 million by FY27. So despite a minor recent blip, the future outlook for net profit is very positive.
So revenue and profits expected to grow significantly. What about the margins themselves? Are they getting better at making profit from each sale?
Yes, that's another key point. The report highlights a general improvement trend in both their gross profit margins and their EBITDA margins.
Okay.
And that trend is expected to continue, driven by two things mainly. That increasing proportion of sales from the specialty products.
Right, the higher margin ones.
And importantly, that anticipated reversal of the unfavorable tariffs we talked about earlier.
Okay. Because tariffs can really bite into margins.
They certainly can, yeah.
Now, what about debt? A financially healthy company usually manages its debt well. How does GHFL look there?
Their debt levels seem pretty manageable, actually. Good sign. Their long-term borrowings decreased from FY22 to FY23.
Down from what?
$11,170 million down to $754 million. And short-term borrowings also saw a slight reduction.
Okay.
So it's just they aren't overly leveraged, not too reliant on borrowed money.
That's good to hear. And liquidity. Can they cover their immediate bills?
Well, the report doesn't give us specific ratios like the current ratio, but it does mention their cash.
How much?
They held substantial cash and equivalents, $1,633 million in FY22, and $11,117 million in FY23.
So a decent buffer.
Yeah, indicates a reasonable cushion for near-term financial needs.
And are they investing back into the business? You mentioned fixed assets?
Yes, exactly. The report shows investments in fixed assets are increasing.
Which suggests?
Suggests they're expanding production capabilities, which lines up perfectly with the growth strategy.
Right. Yeah.
To capitalize on that growing global demand for specialty films, they're putting money into the machinery and buildings needed for future growth.
Okay, so the financial picture seems, well, quite promising based on these projections. Let's dig a bit more into what's really fueling this optimism. We've touched on it, but what are the core growth drivers?
Well, the primary drivers are Those significant projected increases in revenue and earnings we just went through.
Okay.
And those are directly tied to the expanding global demand for specialty films. It's a large market. It's still growing.
And GHFL is positioned to grab a piece of that.
Exactly. With their existing global presence, their established distribution, they're seen as well-positioned to capitalize.
So while the tariff reversal is like a near-term shot in the arm,
Yes, a catalyst.
the bigger picture is the underlying health and growth of the whole specialty films market. That's the long-term story.
Precisely. That global specialty films market is a substantial, ongoing opportunity. GHFL's strategy seems to be twofold.
Which is?
Increase their market share within that space and boost their profitability by focusing on those higher margin differentiated products we keep coming back to.
Market growth plus better profit per sale.
You got it.
And this focus, the strategic shift, is expected to really move the needle on their profitability metrics.
Absolutely. The anticipated improvements in both EBITDA margins and PAT margins. They strongly support that positive outlook. It's not just about selling more volume. It's about getting more profit from each thing they sell.
Okay. But no analysis is complete without looking at the risks, right? The potential speed bumps. What did the report identify there?
Good point. Yes, the report does flag a few key risks. First, like we've said, that past negative hit from the unfavorable Indian tariffs.
Right.
It serves as a reminder that external policy changes can hurt profitability. Even if a reversal is expected now, it's a known factor.
Okay, so policy risk. What else?
Second, potential for increased competition. The global specialty films market isn't, a monopoly.
Fair enough.
So maintaining their edge product differentiation, market share, that's going to be crucial. Always is.
And being so global, they're exposed to trade complexities generally, aren't they?
Exactly. The report actually mentions the past impact of tariffs on their U.S. exports specifically.
Ah, okay. An example.
Yeah, so navigating that whole complex, ever-changing world of international trade policies, that's going to remain important for them.
Any other risks called out?
The last main one mentioned is the potential impact of raw material price fluctuations.
Input costs.
Yeah. As a manufacturer, if the cost of their key inputs goes up significantly, it could squeeze their margins unless they can manage those costs really well or, pass them on to customers.
Right. Okay, so there are definitely things to watch out for: policy, competition, trade, input costs. Now, the valuation part. A 62% upside target. How do they get there? What's the price target?
Okay, valuation. The report sets a target price of 3,300 rupees per share.
4,300 rupees.
Yes, and that's what translates to that 62% potential upside based on where the stock was when they wrote the report.
And the logic behind that, you're up 4,300.
It's mainly based on their projections for future earnings growth, plus that anticipated positive impact from the tariff reversal finally kicking in.
And technically, how did they calculate it? What methodology?
According to the report, they derived that target price by applying a PE, multiple price to earnings, multiple of 18 times.
18.
Their estimated earnings per share, or EPS, for fiscal year 2027, which they project will be 287.5.
Okay, so 18 times projected FY27 earnings. Is 18x considered, reasonable for a company like this? Did they give context?
Well, the excerpts we have don't explicitly detail why 18x, comparing it directly to peers right there.
Okay.
But they do mention historical PE and exhibit charts being in the full report as exhibits 5 and 6.
So the context is probably in those charts.
Usually, yes. Those charts would show how the market has valued the company historically relative to its earnings and its enterprise value.
Right.
An analyst uses that history, plus future growth expectations, maybe comparisons to similar companies, to land on what they think is a fair multiple. And generally, a growth company often gets a higher PE.
Okay, so summing up the valuation piece. Analysts think if GHFL hits these earnings projections and the market values those earnings at a multiple, that seems reasonable based on history and growth prospects.
Then the stock price has the potential to reach that 4,300 target.
Makes sense. It's a forward-looking valuation, hinges on them delivering and the environment improving as expected.
That's a good summary, yeah.
Okay, we have covered a lot of ground here in this deep dive. Let's try and boil it down. What are the absolute key takeaways for our listener from this bullish analysis of Garware Hi-Tech Films?
Okay, key takeaways. Number one, GHFL looks well-positioned for some pretty significant growth in the next few years.
Right.
Number two, that growth is expected to come from their strategic focus on high-margin specialty films.
The value-added stuff.
Exactly, which serve a big, expanding global market. And number three, A crucial factor underpinning all this is that expected reversal of the unfavorable tariff situation.
Which has been a drag but could become a tailwind.
Precisely. And Monarch Networth Capital clearly sees substantial upside potential based on all this.
Hence the BUY rating and the big target price.
Exactly. It reflects their confidence in the company's strategy and the expected improvement in the operating environment.
So what does this all mean for you, our listener? Well, it gives you a really interesting snapshot, I think, into a company operating in a fascinating, dynamic global market, this world of specialty films. It really shows the tangible impact international trade policy can have on a business.
Definitely.
And it highlights how that strategic focus, shifting towards higher value-added products, can potentially drive financial performance and, how investors might view a company.
It also really underscores the importance of looking beyond just like headline revenue growth.
Good point.
You need to consider margin expansion, overall profitability. GHFL's focus isn't just about selling more, it's about selling more profitably in segments with strong future demand.
Yeah, that's key. This has been a really insightful look into one company's potential. And thinking about it, these specialty films, they're everywhere, right? Packaging, cars, buildings.
Lots of applications.
It makes you wonder what other seemingly niche or specialized markets out there might be poised for similar kinds of growth and transformation.
That's a great question to ponder.
It really gets you thinking about, the connections in global commerce, these advances in material science, and maybe where the next big opportunities might lie.
Indeed. It encourages looking deeper at those underlying trends shaping industries and how companies are innovating to capitalize on them.